Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back. This is the video recap that we do here each and every night on the membership side of our blog and website, and we go over all of the opening and closing trades that we send out to our members. Now, of course, if you're watching this online on YouTube, someplace else, you're getting this video about 10 to 15 days after it goes out to our members. So again, you can always sign up for a free trial or a membership on our website and get all of these videos the same day that we make these trades. Now today we had 2 opening orders and 2 closing orders, but one of our opening and one of our closing orders were basically one and the same, and it was another vertical roll or a hedge position that we adjusted in our RUT iron condor. So I'm going to go over that last because they kind of go together, but first I'm going to go over the closing trade for Facebook. So we had originally bought a Facebook calendar, the July-June 62.5 call calendar spread. So basically kind of pinning everything around 62.5 as a position for Facebook to move to between now and June expiration. And even though we have part of the calendar is July, we're really focusing on that front month option, which is June, which has about 20 to 23 days to go till expiration. Now we went ahead and sold that back to the market today for $110 credit. So it took in a nice small profit of about $21 per spread. So it was a nice profit of about $42. Not a huge profit, but when you look at the chart that we're going to go to here in a second, you'll see that Facebook has pretty much moved to our strike that we wanted to go to, which is 62.5, which is just about right here on the chart, and it's actually starting to move beyond that point now. Now, because we paid a little over $89 for this trade, that basically moves our break-even points out of almost about $1 or so. It's not exact, but almost about $1 or so on either end. And so really, we're looking at a very, very tight range that Facebook has to trade in between now and expiration. And that range is more or less here on the chart. So 62.5 is where our first or our strikes are. So that's kind of the optimal point. We want Facebook to trade and close right at that level. But between now and expiration, we ideally want Facebook to be inside this range. And it's been inside that range a couple days and moved inside that range just as we had hoped it would do. So this is one of those low volatility trades that's just really meant to keep us active and alert with trading, right? There's practically nothing out there right now that has high implied volatility considering where the market's going. So you have to use your calendars and your debit spreads to get a little bit more active in the market. But again, you want to take those trades off a little bit early too and just kind of lock in some of those small profits. Now, if we did let Facebook kind of run and continue higher, then obviously we're going to lose the full amount. So we don't want to do that. So we're being a little bit more proactive and just taking what the market gives us right now with the move higher. Now, the other trade I want to go over is our opening trade in Priceline. And this is really a pretty simple trade that we usually make on this website and our blog. And that is just a vertical debit put spread. And Priceline was one of those ones where, again, I'll go to the chart here and see, but it's just had a massive rally in the last week and a half. And not to say that I don't think Priceline could go higher or lower, whatever the case is, I'm personally bearish on it. I think at this point, it can't sustain this type of a move, meaning that it can't continue at this growth curve to keep going as high and as quickly as it is right now. So I just personally think that at some point we're going to get a little bit of a correction here. And this is all we're trying to do is play a little bit of a correction. Again, keeping our position size small, only buying one of these, and making it very, very even and very, very simple trading. So what we ended up doing is buying the July options, which give us a little bit more time, and the 1280, 1275 put spread. So because we paid a debit for this, this means that we actually bought the 1280s. So we bought to open the 1280s, and we sold to open the 1275. Now the difference between those two in price is $255. So it's almost exactly midpoint of where we wanted this spread to trade and where we like to buy these debit put spreads at. Now, just a quick side note, I was on a coaching call with a member just the other day this week, and we were talking a lot about vertical put spreads. And one of the things that we talked about is that even though you want to pay the mid price of about the width of the strike, so in this case, it's a $5 wide spread, you ideally want to pay about half of that width to give you a true 50-50 probability. But what you have to understand is that not only do you want to pay that mid price, but you also want to make sure that that mid price is consistent with what the break-even price is on the stock at the time. So in our example here today, and let me just go to the chart, we paid $255 for, $255 for this spread. So that ideally moves our break-even point around 277.50, right? And when we actually entered this trade, Priceline was actually trading below that point. It was trading at right at 1275. Now it's rallied up higher on the day, and that's okay, but it was trading right at 1275. So we actually had bought this spread when it was already making money at expiration. So what that means is that we actually paid a discount to really the true value of where the spread is. Our break-even point was around 1277.50, and at the time, the spread was trading at around 1275. So we actually gave ourselves an extra couple dollars of room there and didn't have to pay for that extra premium. So again, it's a little bit more complicated, a little bit more advanced, but that's what we're trying to do is kind of repetition and firing a lot of these at you guys every single night on these videos and going over these trades. But you can see just how quickly Priceline has moved higher. It seems like in the last definitely in the last couple weeks here, we've just had a rapid move up in the stock, and a number of days that it's consistently moved higher. And this is a stock that moves very fast, so there's nothing to say that this thing can't completely reverse this trend and move back lower between now and June expiration. And look, we're giving ourselves all the way out until July expiration to be right on this trade. So we have a lot of time between now and July expiration for this thing to trade anywhere below where our break-even point was, around 1277.50. So that's really kind of the line in the sand. We want Priceline to trade anywhere below that level between now and July expiration. So we've got a lot of time on our hands, and there's a very small trade. We can afford to hold it all the way through expiration if need be until we see a nice little profit in this. All right, so let's talk about the roll trade that we had in RUT. So this is one that we actually just rolled earlier this week, and considering the market continues to move higher, we're going to keep rolling up this put side trade and keep taking in more credit. Now, as you know, and if you keep watching a lot of these videos and go back and watch other videos where I talk about rolling, what we want to do with iron condors is we want to roll the side that the market is not moving against. So in this case, the market is moving against our call spread. We want to go ahead and continue to lock in profits and roll up the put side of our trade. So you'll notice that the actual closing order was to close out of our 10.80-10.75 put spread that we had originally sold for around 90 cents. So we closed that out at 55 cents, made a little bit of money, and then we also went in and rolled and reopened a new position at 11.10, 11.5 on the put side as well. So we continued to roll this trade up to closer strikes to the market because the market's moving away from us. By doing that, we also took in a credit here. So if we really net out the credit that we received and the debit that we paid on this, we took in an additional net credit of around 55 cents on the trade. Now, why does this matter, right? Well, as we get closer to expiration, the window of opportunity for the market to make vast, big moves outside of just a normal standard distribution becomes smaller, right? Because it has less time to make that move. So days till expiration continue to decrease, and the market has less time to make a dramatic move. So as we roll in and come closer to the market, we kind of almost choke off the market with extra premium. So by rolling up to and closer to the market, we increase our premium, which widens out our break-even points. And also by maintaining the same number of contracts, which I continue to harp on time and time again, the same number of contracts and the same width of the strikes. So you see we rolled to a $5 wide strike after we closed out a $5 wide strike. If we keep both of these in check, then we are actually increasing our likelihood of either having a smaller loss with the increased credit or actually increasing the potential profit that we do have on the trade should the market turn around. So by adding no additional risk to this position, we actually have less loss now than we could have ever had we not done anything. So again, just like the Pfizer example that we used the other night, where we had hedged the Pfizer trade and turned basically a full loser into a small profit, what we're looking to do here with this strategy and this hedge is either A, reduce our loss, or B, turn what could be a potential losing trade into a profitable trade. So if I go to the actual Analyze tab here on Thinkorswim and type in RUT, so you guys can see this on here. Now this is what our iron condor looks like. Originally we had a position out here at 1080, so our iron condor was a little bit wider than it is now, but it was shorter because we didn't have as much credit. Now we didn't touch this side right here, so we did not touch the call side. Instead, we closed out the put side and rolled it up and closer to the market. So you can see we're still giving ourselves some room between ourselves and the market. The RUT closed around 1140 here, and you can see that that's right kind of on the cusp of where our position is right now on the top side. So the call spread is kind of right there, but we still give ourselves a lot of room between 1140 and 1110 on the bottom side should that the market continue to sell off possibly, or even just have a little bit of a sell off, that we actually have a window of opportunity to make some money. And if nothing else, the market continues higher, we'll keep rolling this thing up and reducing our potential loss on the overall trade. So at the end of the day, rolling is a really, really good strategy for these iron condors, and making these adjustments, you have to be a little bit more nimble and just understand how the adjustments work, keeping in mind that you always want to take in a credit when you're doing these adjustments. You never want to pay to roll up or roll in on these iron condors. As always, hope you guys really enjoy these videos. If you have any comments or questions, please add them right below here. I'll get back to all of those tonight or tomorrow before the open, and happy trading.